All six major banks beat profit expectation, helped by a combination of solid Canadian personal and commercial banking, stronger capital markets activity, decent wealth management results, and credit losses that were generally manageable. And it's not surprising that capital markets and wealth managements have done pretty well, just seeing how the markets have done overall in that period of time. Typically, those segments tend to go along with how the markets are doing. And the main takeaway is that even if Canada is entering a technical recession during the first quarter, the banks still delivered pretty resilient earnings. I'm honestly a bit surprised how well they're doing, but good for a whole lot of you, because I know Canadian banks stocks are still some of the most widely held stocks in Canadians' investment portfolios. So very happy to see that. I know overall they've been performing very well over the past year. So the second point here, domestic banking held up surprisingly well. So this was probably the most important part of the quarter. In a weaker economy, you would expect Canadian banking to be under more pressure, but several banks still posted solid growth in personal and commercial banking, obviously on the domestic side. So in Canada, and that's especially impressive when you factor in that we entered a technical recession. So 2 quarters in a row of declining GDP from Q4 last year to Q1 of this year. And despite all of that, the big six perform extremely well. So RBC's personal banking profit was up 17%. This is all year over year. TD's Canadian personal and commercial banking net income was up 15%. CIBC's Canadian personal and business banking profits was up 15% as well. Scotiabank Canadian bank earnings were up 53%. National Bank saw its personal and commercial banking up 18%, and BMO personal and commercial banking was up 15%. So across the board, some really strong growth. Now, moving on to capital markets. So there were major tailwinds for the banks, with the exception of National Bank. That was the outlier here. They saw a 3% decline. BMO was up in terms of profits 47%. TD's wholesale banking, which does include capital markets, saw net income up 40%. CIBC was up 40%, and Scotia's global banking and markets earnings was up 11% as well. Next, credit is still the main thing to watch for Canadian banks, at least from a risk perspective. So provisions for credit losses, or the money that banks set aside every quarter for potentially bad loans, were significantly lower than a year ago. But sequentially, so compared to Q4, the picture is definitely more mixed. When you start comparing that to last year, provisions were roughly stable overall. Scotia and CIBC actually saw high single-digit increases in provisions and PCLs, while the other major banks were mostly in line with the prior quarter. Allowance for credit losses, or ACL, as a percentage of gross loans also remained elevated versus historical norms. So essentially, you just take the percentage of the amount of money that's set aside for bad loans on the balance sheet, and you compare it for the total gross, because the provisions for credit losses, so what makes the headline every quarter, is just the additional money that the banks puts on its balance sheet. And then on the balance sheet, some of that money will be written off, and sometimes they're not writing off as much as they thought. So it kind of ebbs and flows. And again, if you look at this specifically, it's below the COVID peak in the past 10 years. But if you remove the COVID peak, it's essentially the highest it's been in the last decade. And obviously, 2020 was a bit of an aberration in terms of that, because we saw the banks adding significantly massive amounts to their provisions for credit losses every single quarter. So the allowance for credit losses really ballooned. And because they just didn't know what would happen, we saw all these shutdowns. We had no idea. The banks had no idea. And then the governments really started just pumping out stimulus into the economy. And then they reversed a lot of those PCLs. So it actually boosted their profits for several quarters, if not years after that, because they were able to release a whole lot of that money they had set aside because they were no longer in need of it. And the good news is that the credit reserves appear to have plateaued, at least for now. You see that big peak that I talked about during COVID, and then you just see a big slope down and then a steady slope up for all the banks to right now. It We'll have to see whether it's peaked or not. The glass half full view is that credit metrics appear to have plateaued despite 2 weak quarters in a row for the Canadian economy. The glass half empty view is that credit losses can definitely lag the economy, because if people start losing their because the economy is slowing, oftentimes it will take some time until it starts trickling into delinquencies, until banks may start seeing that and start provisioning higher. I thought the banks would have to be provisioning more than they have and keep having those going up, especially with the trade uncertainties that we're seeing for the US. So I've been a bit wrong myself. So there is definitely two sides to the argument, and I wanted to mention that here. The next thing here from the banks, and the last thing, so if you own bank stocks and you like dividends, you probably like this quarter a whole lot, especially if you own most of the big banks. So several banks raised their dividends, which is definitely meaningful because the Canadian banks, they do have a reputation of being pretty conservative with dividend increases and just capital allocation in general. Obviously, we can go back to the GFC and how well the Canadian banks actually weathered the storm compared to their US counterparts. Whether they're still that conservative right now, yes, that's up for debate, especially with some of the loans that they did in housing. But nonetheless, they definitely feel confident if you start looking at the dividend raises they did. So RBC raised its quarterly dividend by 7%. TD raised it by 3.7%. BMO raised it by 2%. Scotia raised its dividend by 4%. And National Bank raised its dividend by 6%. CIBC, on the other hand, was the only bank to keep it unchanged, but I would not read anything into that because CIBC typically increases its dividend in Q4.